Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. In today's video, I'm going to cover a subscriber request where I was asked to compare Huntington Ingalls in the aerospace business versus Lockheed Martin, also in the aerospace business. And there's really some interesting things about looking at these two companies together, but also looking at them separately. There are some lessons in valuation. There's just some lessons in what kind of company you want to invest in and how you can analyze the company and evaluate it. So I'm going to spend some time on both companies, but because I'm covering two companies, I'll be brief, but I will try to give you some insights into how I would go about researching these two companies and why. So let's go ahead and move into the fast graphs and get started. The first company I'm going to start with here is Huntington Ingalls. Now, a couple of things about it I want you to note as we kind of go through this. This is about an $8 billion market cap company. Okay, it's got an earnings yield of 6.86%, which is very good. That means it's in value, and I'll talk about that. It's got a dividend yield of about 2.63%. It's BBB minus rated, and it has 35, almost 36% long-term debt to capital. So as we look at this company, a couple of things immediately come to mind. I don't have prices on this graph yet. I'm going to add those here in a moment. But what I do have is I have the earnings per share, adjusted operating earnings is what I'm looking at here. And I've got those plotted, which is the orange line. Now, the normal PE line is also on here, and you'll notice they're almost superimposed with the orange line, which means the market basically prices this around 15 times earnings. Remember, it's never a perfect number. It's also always a range of numbers. I see that they started paying their first dividend in 2012. They increased the dividend significantly the first year, and then they doubled it the second year, increased it by 70 cents the third year, and you can see the dividend growth has slowed down, but they've got this very nice consistent record of increasing their dividend. So if you're an income investor, that could be very desirable for you because you got a stock here that has a history of increasing its dividend with a minimum amount of debt. Now, because it pays the dividend, I'm going to look at a couple other aspects here that I consider important when you're considering dividend-paying stocks. Number one, I'm going to look at operating cash flow. Now, what I want to see here is I want to see the orange line on the graph, which is the operating cash flow, be higher than the white line, which is the dividends. So, for example, in December of 2015, the company generated $17.14 of operating cash flow and paid out only $1.70 in dividends. So you can see they have more than ample cash flow to cover their dividend. Now, what I always consider the asset test, let's look at free cash flow to equity, which is the money that they have left over after all the money charges to run the company. They also have very good coverage of free cash flow to equity, although they did get into negative territory for a short period of time here in 2024 last year, but they are expected to recover and have free cash flow to equity that's above the dividend. Now, the fact they only have 35% debt, 36% debt, would indicate it's pretty safe there. Now, looking at a couple of aspects, I would go through all these metrics. I'd go through EBITDA, EBIT, which is operating income. I'd go through sales and just see what kind of sales the company generates. I want you to notice that their sales growth has been a lot more consistent than their operating earnings. So looking at these aspects of the company, when I look at operating earnings, the final thing that strikes me is the company did grow at 11.95% from period A to period B. But if I shorten that time frame to only an 8-year graph, then the growth is only 4.46. I had some dialogue with a subscriber on my last video, or one of my recent videos that talked on Eli Lilly, talked about shortening the video. One thing you should always do with FastGraphs, it's the Fundamentals Analyzer software tool. It's meant to analyze stocks. If I look at this graph, I can see that I had very high growth going up here through 2018. All right. Now I can use my scroll bar and just from analytical point of view and bring it back to that peak earnings there. And I had earnings growth of 27% from 2011 all the way up to 2018. But then as I brought it forward, the growth then slowed down to this 4.46%. So the company's earnings growth has slowed down quite a bit. Okay, but in the long run, it did generate 11.95% growth. All right, now before we finish looking at this one, let's go ahead and kind of run Lockheed Martin, which was the comparison I was asked for, through a very similar analysis up to this point. Okay, when I look at Lockheed Martin with the same aspect, I have an 11% grower. I have a company that's paid a dividend a lot longer. They were paying a dividend for this whole 20 years. You can see they've steadily increased the dividend every year, year after year after year. It's almost a 3% yielder as of yesterday's close. It's A- rated, but does have 73% debt. Now, it's a $102 billion market cap, so it's more than 10 times bigger than Huntington Ingalls. Now, that would be something I would take into consideration. The company does have a lot of debt, but let's run it through the cash flow analysis. From a standpoint of operating cash flow, Lockheed Martin, again, has more than adequate operating cash flow. They did get close in 2012 where they paid a $4.15 dividend and only had $4.75 in cash flow. Likewise, in 2018, they had just under $11 in operating cash flow and had an $8.20 dividend. Now, when I look at free cash flow, looking at Lockheed Martin, remember, this is the much bigger company. From the free cash flow point of view, they did have two periods, but more recently, their free cash flow has been more than adequately covering the debt. Now, when I run this through the same process, let's look at sales first, because I looked at sales and the other. Let's look at the steadiness and the level of sales the company generated. Now, they've done about 6.5% sales. Their sales growth has been very steady, just like we saw with Huntington Ingalls. So there's a lot of things that are similar between these two companies. They're certainly both in the same industry. Now, by the way, with fast graphs, I could go to my external links and just immediately go to the company's corporate website, in addition to looking at a lot of other different research sites and kind of learn about what the company is and what the company does. So here we're looking at Lockheed Martin. Now, I'm going to go back to operating earnings. I want to make a point like I did before on Huntington Ingalls. When I'm looking at Lockheed Martin, it had 11% growth also, but if I run it as an 8-year graph, I'm also down to 4% growth. Now, I'll do this on both companies. When I'm looking to the future, which is where I'm going to invest, Lockheed Martin has an 11.68% growth expectation. Huntington Ingalls has a expectation of 11% growth as well. Companies in the same industry and have similar growth rate characteristics over time. So there's a lot of similarities between these two companies. I do want to make that clear, even a level of cyclicality and so on. Now, when I put price on the graph, and this would be weekly closing stock prices, which is the black line on the graph, what you see, like you always do, that the business is what generates the stock price movement. In the long run, earnings determine market price and will obviously be the thing that generates the return that you're going to get based on the valuation you pay to buy a company. That's so important. We always want to buy at or below the orange line so that we either participate fully in the growth of the company, or if we really get it when it's cheap, we can actually make money in excess to the company's growth rate. Here we've got an 18% rate of return on a company that grew just around 11% during that time frame and did pay a dividend, but we've got a much better rate of return because we were able to buy it when the stock was cheap, okay, if we had actually been smart enough to do that back then. Right now, it looks fully valued, but fairly valued. It's trading at a 14.7 PE, and it has a 6.8% earnings yield. So that's a little below the 15 PE kind of benchmark, if you will, which indicates fair value. So it's not dirt cheap like it was back here in these other years, but it's reasonably inexpensive. Forecasting, as I mentioned earlier, we're looking at 11% growth. If you buy the stock now, counting dividends, and hold it, and the earnings come out as analysts expect, then you could be making double-digit returns, 14, 15%. If you look at the next 2 years, it'll be about 13.5%. Okay, so Huntington Ingalls looks like a very attractive buy right now. They have modest debt. Now, I can analyze a company like this with fast graphs a lot more extensively. I can go into fund graphs, for example, which stands for fundamental underlying numbers. I can go look at things like the balance sheet, okay? And on the balance sheet, I can check things like short-term debt versus long-term debt, okay? And I can also do total debt. So what you see here is the majority, the purple line here is long-term debt. The majority of the company's debt is long-term. They do have minuscule amounts of short-term debt, which means the company with the kind of cash flows we looked at earlier probably is not going to have a big problem paying off their debt. When I look at Lockheed Martin, remember we're comparing two companies in a similar industry here. When I look at Lockheed Martin through this kind of analysis, I see a very similar story. We'll just shorten the time frame here. We see long-term debt is the majority of their total debt, okay? And short-term debt is relatively small and minuscule. So even though this one does have 73% debt to capital, which is an advantage, Huntington Ingalls, if you will, they do have the cash flow and the ability, it looks like, to be able to pay that debt, okay? Now, the difference is with Lockheed Martin, when I look at the stock price, I'll add the normal PE. The market also prices this around a 15 or 16 times earnings level. That's historically been accurate, okay? It's been overpriced as early as last October, and it's been coming into fair value, but I would argue this one is still a little bit overvalued. These four orange lines represent a valuation quarter. This would be high fair value, this would be fair value, this would be low fair value. And it's obviously, if it grows at 11% a year, it could generate a 7% or 6% annualized rate of return if these analysts, and there's more analysts following this bigger company than we saw with Huntington Ingalls. But the point being is that it could be a buy today if you're interested in that dividend yield. It would be a better buy if the price got a little weaker and dipped down into these orange lines. So this would be one you either buy now or watch. When you get back to Huntington Ingalls, then you see a little different situation here. They're expected to have a relatively weak this year, but then do well. And again, we could get double-digit rates of return because we've got a better value with this stock. Now, there's a lot of other things you can do with fast graphs. I just want to mention them. You can go through fiscal fitness, and you can look at things. I'm on Huntington Ingalls here. You can look at margins very quickly, and effectively this gross margin, which has been dropping, operating margin, which has been dropping, and net margin, and it's only got about a 5 or 6% margin. Now, do the same exercise with Lockheed Martin, and you're going to see a very similar pattern been dropping. They've got a little better net margins than we saw with Huntington Ingalls. Okay, so this is obviously a major company. They've got more debt. So when I'm looking at these two companies, when deciding which one I want to buy or analyze, Lockheed has come down significantly from being overvalued. That's one lesson. You can see every time it's been overvalued in the past, you eventually got an opportunity to buy it at a more attractive valuation. I still think it has a little ways to go yet. I'd be interested, and I've owned this stock, and I've loved owning this stock, but I'd be worried about buying it today. The best time to buy these aerospace and defense companies would have been back coming out of the Great Recession, where you could buy them at almost 10 multiples. It's looking good. It's got a good dividend yield, great dividend record. It's got a level of debt, but it's manageable debt. If I go to Huntington Ingalls, in contrast, much smaller company, much lower debt level, a little more inconsistent, a very excellent dividend record for the short time they've been paying one, and a much better valuation currently. It was overvalued as well. It got, of course, this would have been the best time to buy it. It would have been in February. But again, this is a subscriber request series where I could compare the two companies. So I like both companies very much. I do want to make that clear. Lockheed Martin is certainly a great company. Huntington Ingalls is also a very good company. It's got an investment grade rating. It's got less debt. Both companies have about the same growth potential. So as an investor, you would have to decide which, if either, that would fit in your portfolio. If you're looking for income, even though Lockheed Martin's a little more expensive right now, it's probably the better buy because it has a current yield of 3%, and both of these companies should be growing their dividend at about the same rate going forward. So there's a lot of lessons here in these videos. The idea that earnings in the short run can be driven by emotions. People can get excited, but in the long run, stocks tend to revert to the mean and trade at their intrinsic value, supported by fundamentals. And that's what the orange line on the fast graph is attempting to show you. And when it gets way above that, it'll correct. When it gets way below that, as long as fundamentals stay reasonably strong, the company will correct. And here's a good example. The company's earnings responded from dropping in 1 year. The stock price responded. Then the company's earnings, as the quarters passed, had a couple of weak quarters, and the earnings dropped about 20% that year. The stock price followed suit. Then they started growing again. The price got high, and so on. So you'll see that with either one of these companies when you're looking at them. And really most companies, Earnings will determine market price in the long run. When they get overpriced, they tend to come back in value. When they're underpriced, as long as fundamentals hold up, that's the best time to buy them. I think this was a little expensive. Huntington Ingalls is a little cheaper. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, Fundamentals Analyzer software tool. I hope you enjoyed this subscriber request video where I was asked to compare Lockheed Martin to Huntington Ingalls. Both these companies have a lot of similarities. That was another lesson I think the video should have taught. That a lot of time when companies are in the same or very similar industry, the same economic dynamics will have an impact on what their ability to grow earnings, generate cash flows, pay dividends, etc. If you liked the video, give me a like. Subscribe to my YouTube channel if you haven't already for more videos like this. And also take a look at subscribing to FastGraphs. I consider it the value investor's best friend. Thanks for watching, and we'll talk to you again real soon with some 2-minute drill videos I got planned for this week. Thanks.